Imagine this. You've been paying $35 a month for a term life insurance policy for the last 10 years. You feel responsible, protected. Then the term ends. Your insurance company sends you a letter that looks like a renewal offer. But it's not. It's a financial ambush. They're about to jack up your premium by 700%, 800%, even 1,200% overnight. And if you don't read the fine print, you'll be paying $47,000 more over the next decade for the exact same coverage. This isn't a glitch. This is how the insurance industry makes its real profit. And almost nobody talks about it because it's buried in actuarial tables and policy jargon. Today, we're going to expose that trap and show you how to sidestep it permanently. Why does this matter right now? Because we're sitting in a rate hiking cycle. Insurance companies are raising premiums across the board. According to the 2026 Insurance Barometer study by LIMRA, 48% of Americans say they overestimate the cost of term life insurance, but the real crisis is what happens when those term periods end. A 2025 study from the Society of Actuaries found that 67% of term life policyholders who let their policies renew experienced a premium increase of over 500%. And the average American household is already spending $2,300 a year on life insurance premiums. If you are one of the millions of people approaching the end of a 10, 20, or 30-year level term policy in the next 24 months, this isn't a theoretical problem. It's a ticking time bomb on your budget. Think of your term life insurance policy like a first-class airline ticket you bought 10 years ago. You paid a fixed price, got a seat, and felt secure. But when the flight lands, your term ends, the airline doesn't offer you a new ticket at the same price. Instead, they tell you that to stay in the same seat, you now have to pay the price of a last-minute, walk-up first-class fare, which is 10 times more expensive. The seat is the same, the plane is the same, but the pricing has changed completely. And the worst part? They let you keep sitting there, charging your credit card, until you realize you're paying for a private jet when you only need a bus ticket. The guaranteed renewal mirage. Most term life policies include a guaranteed renewal clause. Sounds safe, right? But it's a trap. Guaranteed only means they can't deny you for health reasons. It does not lock in your rate. The premium is recalculated based on your current age. A 45-year-old non-smoker might pay $35 a month for a 20-year term. At renewal at age 65, that same policy can jump to over $400 per month. The insurance company banks on you not shopping around because you're afraid of a medical exam. 2. The 80% lapse rate reality. Data from the American Council of Life Insurers shows that nearly 80% of term life policies never pay out a death benefit. Why? Because people either let them lapse or they can't afford the renewal. The industry knows this. They price the initial term low to get you in the door, knowing the real profit is in the tiny fraction of policies that convert to expensive renewals. You're not buying protection, you're buying a lottery ticket where the house always wins. Your health is your biggest asset. When you renew, you lose the leverage of your younger, healthier self. A 35-year-old with a clean record can lock in a 30-year term for peanuts. But a 55-year-old with slightly elevated blood pressure, the premium doubles or triples. The secret is to never let a term policy expire. Instead, buy a new, cheaper policy while you're still healthy, cancel the old one, and start the clock again. This is called laddering, and it's the single most effective way to avoid the renewal trap. Number 4. Most agents don't tell you about. Many term policies have a conversion privilege that lets you switch to a permanent policy without a medical exam. But agents rarely mention it because it hurts their commission on the new policy. If you convert, you lock in a rate based on your original issue age, not your current age. This can save you thousands. The catch? You usually have to convert before a specific age, often 65, and within the first 5 to 10 years of the policy. Check your contract today. This one paragraph could be worth $20,000. 5. The 10-year rule. Why you should never keep a policy past year 10. Statistically, the sweet spot for term life is the first 10 years. After that, the probability of a claim increases and the insurance company's profit margin shrinks. Their solution? Raise the renewal rate to push you out. A smart strategy is to plan for your policy to end. If your kids are grown, your mortgage is paid, and your spouse has their own income, you might not need life insurance at all. Don't renew out of fear. Reassess your actual need. If you still need coverage, buy a new term policy before the old one expires and use the savings to invest the difference. Here's your single actionable step. Pull out your life insurance policy. Find the renewal date and the conversion privilege section. If your renewal is within 12 months, start shopping for a new term policy immediately, before you hit that age milestone. Do not let the policy auto-renew. You have 30 days after the renewal date to cancel and get a full refund of the new premium. Use that window to compare rates. And if you want to know the exact formula I use to calculate whether you even need life insurance, click the video on your screen right now. It's called the $1 million question. Do you actually need life insurance? Subscribe so you don't get ambushed by your own insurance company.